Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
Today's episode is yet another cautionary saga of Mojocare, a Bengaluru-based health tech startup that once promised to revolutionize wellness and sexual health space. It even raised $23.6 million in funding by 2022, but faced significant financial irregularities reported in mid-2023, thereby leading to major downsizing and winding down of operations in 2024. Let's break the story into 4 parts, followed by key lessons for founders. Part 1. The Rise. Founded in May 2021 by founders Rajat Gupta and Ashwin Swaminathan, Mojocare entered the health tech scene with a lineup of subscription-based personal care items like intimate wash, body cleansers, and wellness supplements that were tailored by gender and life stage. Riding the wave of rising digital health trends, it collectively raised $23.6 million from marquee backers like B Capital, Chirati Ventures, and PeakX5 Partners, formerly Sequoia Capital India. By late 2022, Mojocare's valuations hovered around $75 million, and it claimed strong growth in month-on-month revenues, or MRR. At this point, the narrative replicated that of a textbook growth stage startup, achieving product-market fit, viral marketing, and high customer lifetime value. Employees quickly swelled to 200, and the founders spoke confidently about profitability and international expansion. But as the saying goes, not all that glitters is gold. Part 2. Red Flags and the Unraveling. Fast forward to June 18, 2023. In a joint statement, Mojocare's investor consortium suddenly announced they had uncovered financial irregularities in Mojocare's books and thus would be scaling down operations to protect their investments. Within days, the board initiated a forensic audit led by Deloitte. The audit uncovered the 3 serious irregularities. A. Inflated revenues. Mojocare was allegedly recognizing the upfront revenue by either forging or recycling vendor invoices in order to make the top line look robust. B. Related party transactions. The Morning Context and others had reported that some vendor partners were linked to the founders, raising serious conflicts of interest. C. Unsustainable unit economics. Beyond the fraud, unit economics were quite shaky. Heavy customer acquisition costs combined with razor-thin margins on consumables meant that even the authentic revenue wouldn't have sufficed for long-term viability. As a result, roughly 8% of the team, or over 150 employees, were laid off in a first wave, marking the shift from hypergrowth to crisis mode. Part 3. Boardroom decisions and mass layoffs. By July 5, 2023, investors faced 2 options: a fire sale to a strategic buyer or a full wind-down with the balance capital returned to LPs. Sources close to the board revealed that the consolidation talks with larger health and wellness players were explored, but it fell through. The consensus, the business model, tainted by financial misreporting and still unprofitable, wasn't salvageable. With the last known dialed-down valuation of $67 million and only $12 million remaining in the bank, the runway was short. More than 200 employees or entire team ultimately lost their jobs by July 2023. This was the ultimate collateral damage due to governance breakdown. Although the forensic audit reportedly clean-chitted the founders on direct embezzlement, it confirmed that revenue figures had been systematically inflated in internal presentations to investors and the board. By October 17, 2023, the formal resolution was passed: shut down operations and return capital to investors. Vendor settlements delayed the final payments, but the intent was clear: to protect LP interests over chasing a mirage of growth. Part 4. The Aftermath. So, what remains of Mojocare? The brand is offline, the product's delisted, and the website redirects nowhere. Investors have either started the refund process or absorbed the write-down. The founders publicly continued to deny all accusations of money being taken out and assert they're figuring out what's best for the business, but reputational damage was deep. The collapse of Mojocare raises broader questions about due diligence, governance, and the health tech sector's challenges such as a. Exit velocity versus sustainability. Rapid scaling may impress VCs, but without sound unit economics, startups implode. B. Governance gaps. Related party transactions and weak board oversight can hide cracks until they become chasms. C. Investor vigilance. Forensic audits are becoming routine. Investors need stronger covenants and real-time financial monitoring. D. Founders' integrity. Inflated figures may buy runway, but they erode trust irreparably. Finally, the key takeaways for founders. Here are the 5 key lessons from Mojocare's downfall. 1. Build transparent financial controls. Early adoption of rigorous internal audits, clear accounting policies, and an independent CFO can prevent small distortions from snowballing. 2. Avoid related party pitfalls. Any vendor or partner tied to founders must be fully disclosed, kept at arm's length, and subject to third-party verification. 3. Prioritize sustainable unit economics. Demonstrate real gross margins and CAC versus LTV ratio, even if it means slower growth. 4. Engage your board proactively. Regular, candid updates to the board and investors build trust. Surprises destroy it. 5. Cultivate a culture of accountability. Your team must feel empowered to raise concerns without fear. Whistleblower policies aren't just lip service. Mojocare has joined a league of several startups that cooked up fake revenue expense numbers and faced forensic audits. The list includes Big Spoon, Go Mechanic, Pirate Pay, Medicabazar, Trell, and Zilingo that were also caught in financial irregularities, fraud, and founders' personal gains. We've covered in Jasa Rodeo most of these startup stories. Do listen to the relevant episodes for deep insights for founders on what not to do. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.